Hello and welcome to Killik & Co.'s 2015 predictions. Last year was a mixed year for equities, with the US market being the strongest market, with the S&P 500 up around 12% and hitting record highs. Japan was also a strong market, with the market up 10% as the market-friendly policies of Abenomics helped improve investor sentiment. In Europe, markets were more mixed, with overall European markets up around 4%. In the UK, the market lagged, with the market effectively flat over the year, and this was given the large exposure to the oil and gas and basic resources sectors in the UK. So what do we think the market will look like in 2015? Well, we feel that there'll be modest global economic growth. In the UK, we're expecting earnings growth of around 5%, which will be lower than other major markets given the high exposure to oil and basic resources. So our target for 2015 for the FTSE is 7,200. This represents around 7.5% upside from current levels. This will leave the market on a forward PE of around 13.2 times, and a dividend yield of 3.9%. Together with the dividend that we expect over next year, this would equate to a total market return of over 10%. So now I'll discuss a few of our key predictions for next year. So first of all, a region that we think you shouldn't be short of is European equities. Although they have had a very strong run, the European economy is still fragile, but it's not all gloomy for European equities. There are still some leading indicators which are looking positive at the moment, and the European Central Bank is committed to more stimulus. In terms of valuations, the market does look cheap. Earnings could surprise on the upside, and the market is relatively under-owned. So if we look at a few charts supporting our view, this is the European PMIs. So this is an indicator of sentiment among enterprises in Europe. And you can see these are all over the 50 level, which is the bullish level for the indicator. In terms of the actual earnings levels, European earnings still look fairly depressed. The top line here is US earnings, and that line there is European earnings. So basically, since the financial crisis, the European earnings haven't got back to the peak compared to the US earnings, which have. And this is partly to do with margins, which still remain relatively compressed in Europe. So you can see this fairly large gap between the margins in the US and Europe. And in terms of fund managers' ownership, if you look at Europe versus the US, European equities are still under-owned. So if you look at this bit here, that tells us that fund managers in general are underweight the European markets, where if you look at that bit there, it tells us that fund managers in general are overweight US markets. So there is potential for money to move across into European equities. Then in terms of a pick to play the European story, here we are recommending a fund, the BlackRock European Dynamic Fund. We like this fund because it has a very well-resourced team. It's got a consistent and strong track record, and it has a blend of fundamental and top-down stock picking, which is likely to be important in the environment where ECB policy is an important determinant of stock prices. In terms of another recommendation, which we're calling one for the brave, this is European banks. Now, the banking sector has been a sector that everyone has loved to hate, but we believe that increasingly the banking sectors are moving towards normalization, especially in Europe now. In Europe, the stress tests have largely been met. Capital levels are now significantly higher than they have been. Bad debt levels are coming down, and the valuation still does appear relatively attractive. So looking at capital ratios, here we can see since the financial crisis, the underlying core Tier 1 equity ratios have increased significantly. As well, credit costs are coming down. So this is a ratio of the amount that banks write off on loans relative to the total loans. We can see that it's on a downward trend. And in terms of earnings growth, the European banks are showing much stronger earnings growth than the wider market. So you can see a big difference in the expected earnings growth next year, but that continues for at least the next 3 years. And in terms of valuations, the European banks do look attractively valued relative to the wider market. So the European banks are on a 12.5 times PE versus the wider European market on a 15.3 times PE. And looking at dividends yields as well, European banks on 3.9% yield versus the overall market on a 3.5% yield. And in terms of price to book, so that's a measure of the valuation of the bank relative to its underlying book value, the European banks are still trading below 1 times at 0.9 times. Now, in terms of wider thematic ideas that we are concentrating on next year, one of the ones that we like is electronic payments. And this is driven from a longer-term shift that we've seen from cash-based payments to electronic forms of payment. And we believe there are 2 drivers which are likely to accelerate this trend over the next year. The first driver is the shift in the fraud liability in the US, and there's also been the recent launch of Apple Pay. So the fraud liability shift. In the US, payment cards are still generally the old magnetic strip and signature cards, and that usually requires you to produce an ID as well when paying with them, so fairly inconvenient. But from October 2015, there will be a fraud liability shift, which means that the merchant will become liable for fraud if they are not able to take a chip and PIN payment. So whereas most of Europe has moved to chip and PIN cards, the US has still been lagging, but this we believe will change with the significant amount of the 1.1 billion cards which are in issue now moving to chip and PIN cards. At the moment, there's only estimated to be 100 million chip and PIN. But what we expect from the move to chip and PIN is an increased usage of cards, especially for smaller payments, as it becomes much more convenient than having to sign for your purchasing and produce ID, where you can do like in Europe now, you just put your card in and put your PIN number in. And it also will reduce the level of fraud. The next major driver we feel is the announcement of Apple Pay. Now what Apple Pay means is that you can link a credit card or debit card to your Apple smartphone, and you can just use that to wirelessly pay with it being done securely using your fingerprint. And because it uses a one-off number that's not related to your credit card, it reduces the amount of fraud. So that Apple Pay has seen very strong support from banks and merchants, and we believe that it will drive adoption of secure mobile payment systems, not just Apple Pay itself, but also competing systems. And again, the increased convenience of being able to just pay with your phone versus having to take a credit card out and sign for it, we believe will accelerate the uptake of card and non-cash payments. We don't believe that this will replace plastic cards entirely, because you will still need your plastic card to have as a backup if you run out of battery or the retailer doesn't accept Apple Pay. So here we've got a graph which shows the expected growth in card payment volumes out to 2018. So you can see, I mean, across all the regions of the world, fairly significant growth rates. The US is obviously one of the most important given the size of the market there, with over 1.1 billion cards in place. So what are our stock ideas to play to this theme? Well, we like Visa. It's the leading player in the card payments market in the US, and we believe it will benefit from the shift to electronic payments. We also like Gemalto, which is a global leader in chip and PIN cards, as well as the electronic software systems that are used to manage those cards. And we also believe that eBay is attractive, given that its PayPal division should benefit from an increase in the shift towards electronic payments, even if it might lose market share. Our next thematic idea is leisure spending. So that we believe will be driven by 2 underlying themes. So first of all, we increased income levels in the middle class in emerging markets, which will allow more spending on leisure activities. And the second is the aging demographic that we're seeing in developed markets, with more baby boomers retiring, and also retiring much richer than they were previously. So if we look at what's happening in the middle class, So this is a graph of the middle class movements expected between 2012 and 2032. You can see this green area here, the growth rate expected there, and that's Asia Pacific. A massive growth in the number of people that will fall into the middle class and be able to afford leisure activities. Then in terms of the aging demographic, this is the proportion of the US population aged 65 or older. So at the moment, sitting here around 14%. By 2030, it's expected to be all the way up here. So a significantly larger amount of people will be in the age where they will have the time and money to spend on leisure activities. So in terms of our stock ideas for this theme, we like Airbus. It will benefit from strong demand for new aircraft as we see increased air travel. We also like intercontinental hotels. It's got a very strong pipeline of new hotels being developed, especially in emerging market areas, with China being responsible for around 30% of the pipeline. We like Walt Disney. A strong driver, we think, is going to be the opening of the Shanghai Disney Resort, which will open up the whole Disney ideas and the Disney characters to a whole new marketplace in China. And lastly, we like Nike. It's the global leader in sporting wear and goods, and with increased time spent on leisure activities, we believe that will be an important driver for their products. And finally, our last thematic idea is biotechnology. This is a sector which has been a strong growth sector for a while, but we believe it's reached an important point of maturity now. You're seeing a number of biotech drugs now getting FDA approval. You're seeing a lot of progress across a number of therapeutic areas with a fairly widespread pipeline of drugs which are pending FDA approval at the moment. And things like cheaper DNA sequencing is allowing more new drugs to be developed using genomics. So we don't believe the sector is expensive given the growth that's coming from it. Although this sector has performed strong recently, we do believe that the stronger long-term growth potential means that it doesn't look that expensive relative to the rest of the market. So given there are a number of recent blockbuster drug launches, we are looking for the market to grow around, for biotechnology to grow around 17% for the next 5 years, and that compares to the overall S&P at around 9%. So if you look at a PEG ratio, which is a relationship of the price to earnings ratio relative to underlying growth, it does look attractive versus the overall market. It's at 1 times versus the overall market 1.7 times. So our top picks in this area are the International Biotechnology Trust or the Polar Capital Biotechnology Trust. And I would encourage you to speak to your broker if you would like more details on these funds. Thank you very much.